ROE and ROA. Return on equity, ROE, and return on assets, ROA, are fundamental financial metrics used by investors, analysts, and business leaders to assess the profitability and efficiency of a company's operations. These metrics provide valuable insights into how effectively a company is utilizing its resources to generate profit and create value for shareholders. Let's delve deeper into the definitions, significance, differences, and industry benchmarks of ROE and ROA. Return on equity, ROE. Definition: ROE measures a company's profitability relative to shareholders' equity. In other words, it indicates how efficiently the company is using shareholders' investment to generate profit. ROE is calculated by dividing net income by shareholders' equity and is expressed as a percentage. ROE equals net income over shareholders' equity times 100%. Significance: shareholder returns. ROE is crucial for shareholders as it represents the return on their investment. A higher ROE signifies better profitability and potential for higher returns to shareholders. Financial health. Consistent and high ROE indicates financial health, stability, and strong performance. It reflects the company's ability to generate profit without excessive reliance on debt financing. Management efficiency. ROE measures management efficiency in utilizing shareholders' funds to generate profit. It helps assess the effectiveness of strategic decisions and operational performance. Industry benchmarks. Financial services. ROE for financial services companies tends to be higher due to leverage and financial intermediation, ranging from 10% to 20%. Technology. Technology firms often have high ROE percentages, exceeding 20%, driven by innovation, scalability, and intellectual property. Consumer goods. ROE for consumer goods companies ranges from 10% to 20%, reflecting brand equity, market share, and operational efficiency. Healthcare. Healthcare companies typically have stable and relatively high ROE percentages, ranging from 15% to 25%, driven by product innovation and regulatory barriers. Return on assets, ROA. Definition: ROA measures a company's profitability relative to its total assets. It indicates how efficiently the company is utilizing its assets to generate profit. ROA is calculated by dividing net income by total assets and is expressed as a percentage. ROA equals net income over total assets times 100%. Significance: asset utilization. ROA reflects the company's ability to generate profit from its asset base. It measures the efficiency of asset utilization and operational performance. Investor perspective. ROA helps investors assess the company's ability to generate profit from its asset investments. A higher ROA indicates better profitability relative to the size of the asset base. Comparative analysis. ROA allows for comparisons of profitability across companies with different asset sizes. It helps evaluate the efficiency of asset utilization in different industries and sectors. Industry benchmarks. Financial services. ROA for financial services companies ranges from 1% to 3%, reflecting the balance between profitability and asset efficiency. Technology. ROA for technology companies varies widely based on factors such as research and development investments and market positioning, ranging from 5% to 15%. Consumer goods. ROA for consumer goods companies ranges from 5% to 10%, reflecting inventory management and brand investments. Healthcare. ROA for healthcare companies ranges from 5% to 15%, reflecting research and development expenses and regulatory compliance. Differences between ROE and ROA. 1. Focus. ROE focuses on profitability relative to shareholders' equity, while ROA focuses on profitability relative to total assets. 2. Capital structure. ROE is influenced by the company's capital structure and financial leverage, whereas ROA is not directly affected by leverage. 3. Interpretation. ROE is more relevant for shareholders and equity investors, while ROA is more relevant for creditors and operational managers. Understanding ROE and ROA enables stakeholders to make informed decisions, assess financial health, and drive sustainable growth and profitability in their organizations. These metrics provide valuable insights into a company's operational efficiency, asset utilization, and overall financial performance, guiding investment decisions and strategic planning initiatives. Useful expressions. Our company's ROE has been steadily increasing over the past few quarters, indicating strong profitability and efficient use of shareholder funds. Investors are particularly interested in our ROE as it reflects the return they can expect on their investment in our company. We need to implement strategies to improve our ROE by optimizing our capital structure and enhancing operational efficiency. Comparing ROE across competitors will help us gauge our competitive position in the market and identify areas for improvement. Our shareholders expect a healthy ROE as it reflects the company's ability to generate profit and deliver value over time. The company's ROA has been declining, indicating inefficiencies in asset utilization and operational performance. Improving our ROA requires optimizing our asset base and streamlining operational processes to enhance profitability. ROA is a key metric for assessing the effectiveness of our asset management strategies and overall business performance. We need to benchmark our ROA against industry averages to determine how effectively we're utilizing our assets compared to competitors. Increasing our ROA will not only drive profitability but also enhance shareholder value and investor confidence in our company. Let's conduct a thorough analysis of our competitors' ROE and ROA to identify best practices and areas for improvement. Our industry benchmarking report highlights the importance of maintaining competitive ROE and ROA percentages to sustain market leadership. Understanding the industry norms for ROE and ROA will help us set realistic performance targets and strategic objectives for our company. Comparing our ROE and ROA to industry averages allows us to identify potential inefficiencies and implement corrective actions to enhance performance. We need to communicate our company's ROE and ROA trends effectively to investors and stakeholders to demonstrate our financial health and growth prospects. Incorporating ROE and ROA targets into our strategic planning process will ensure alignment with our long-term financial objectives. ROE and ROA metrics should be regularly monitored and tracked to assess the effectiveness of our strategic initiatives and operational decisions. Our strategic roadmap must include initiatives aimed at improving ROE and ROA to drive sustainable growth and shareholder value. Considering ROE and ROA implications will help us make informed investment decisions and allocate resources effectively across business units. Integrating ROE and ROA analysis into our strategic reviews will enable us to identify emerging trends and adapt our strategies accordingly. Our high ROE demonstrates the effectiveness of our management team in maximizing returns for our shareholders. We need to maintain a balance between debt and equity financing to ensure our ROE remains stable and sustainable. Analyzing the components of ROE, such as net income and shareholders' equity, will help us identify drivers of profitability. A declining ROE could signal operational inefficiencies or deteriorating financial health, warranting immediate attention. Investors often use ROE as a primary criterion for evaluating the performance and value proposition of a company. Improving our ROA requires a focus on enhancing operational efficiency, reducing costs, and optimizing asset utilization. A low ROA relative to industry peers may indicate the need for strategic realignment or divestment of underperforming assets. Our ROA should be benchmarked against industry standards to gauge our competitive position and identify areas for improvement. Investing in technology and automation can help boost our ROA by streamlining processes and increasing productivity. ROA is a critical metric for evaluating the overall profitability and performance of our business units and subsidiaries. Benchmarking our ROE and ROA against top-performing companies in our industry will provide insights into best practices and performance gaps. Understanding the drivers behind variations in ROE and ROA among competitors can inform strategic decision-making and resource allocation. Comparative analysis of ROE and ROA trends over time will reveal patterns and anomalies that require further investigation. Our ability to outperform industry averages in terms of ROE and ROA demonstrates our competitive advantage and market leadership. Aligning our strategic objectives with ROE and ROA targets will ensure a clear focus on driving long-term value creation for our stakeholders. Our strategic initiatives should be evaluated based on the potential impact on ROE and ROA, prioritizing those that deliver sustainable returns. Regular reviews of ROE and ROA performance will enable us to identify emerging opportunities and risks and adjust our strategic priorities accordingly.